Weekend greetings, fellow traders. It's Sunday, April 13th, just about to the middle of the month, just about to tax day. We are headed into the pre-Easter week ahead. That means Ash Wednesday. It will be the lowest volume of the year for sure. The markets will be very quiet. Then on Thursday, there is options expiration, all squeezed in together, index and equities, and a slew of economic reports. It will also be very light volume because Good Friday, the markets are completely closed, and a lot of traders, especially serious big money players, are away. They're on spring break vacation with their families. They're not in the markets. So you can expect thin volume and all of the usual price movements that go with thin volume in this week ahead. Now let's look backwards here at the past couple of weeks, and I have an S&P chart up, but this could as easily be the NQ. It could easily be the NASDAQ 100, the Russell 2000, or crude oil, quite frankly, because they all look the same. This was back in the end of March. Let's look at March 26th. Large range day in the S&P sell-off, and then the 28th. Let's see, from 1845 to 1860, barely a 15-point range, not bad but small, relative. Next day, 1860 to 1867, 7-point range all day. Next day, April 1st, 1870 to about 78, an 8-point range, 1 point bigger than the day before. April 2nd, about 1877 to, let's call it 1887, a 10-point range, 1, 2, 3 days, absolutely nowhere. Fourth day, Thursday, about, let's call it 1898 to about 1876, 12-point range. And that's counting all the little spikes and extreme moves. Really, the bulk of price action for those days was inside of those little extremes. So you're talking even smaller. 4 days of absolutely nothing. 1, 2, 3, 4 days of absolutely nothing. And then on Friday, the big sell-off began, and they've continued. Here is that big sell-off as we come in the next week to follow. Down here in this lower chart, and so there it begins, and of course that was a large range day, 40 points or so, and then the following day, a little too sensitive on the mouse, 1857 to 35, 22-point range. Next day, 1830 to 50, 20-point range. Next day, 45 to 67, 12-point range. So that was kind of small relative to those prior three. Then 1865 to 1825, another 40-point range on Thursday. And then Friday was 1830 to about 1807, 23-point range or whatever. Moral of the story, they all looked the same in the beginning. There was no way on earth you, me, or anyone else, alive or dead, could tell that this day was going to be small range, or this one, or this one, or this would be large range, or that all of these were. They all start the same. Nobody rings a bell and says, hey, this is going to be a 40-point range here, so you need to trade this one differently than those 7 and 8-point ranges. That decision has to come before the market opens. Before the market opens, you have to decide for yourself, hey, here's how I'm going to manage my trades. I'm going to trade all day, or I'm going to trade until I catch 10 or 15 or 20 points or whatever the case may be, and I'm going to accept the results of the unknown that unfolds in front of me. I'm going to accept the results that on quiet days I may start out profitable, but I'll end up with a loss because market action just doesn't permit profits. And I don't care what method or system you use. I don't care where it came from, who you bought it from, or how you put it together for free or whatever. That's trading. When the markets are making these large range moves, trading is easy. And traders look at that and are like, oh, I should have taken that trade. I should have kept trading. I should have kept trading. I should have taken that trade. I'd be up a bazillion points today. That's true. But you needed to have that exact same attitude 2 weeks ago. The same attitude 2 weeks ago when markets went nowhere and just chopped and chopped and chopped, and you would have taken whatever profits you may have made and turned them into net loss for 3 or 4 days straight, is the same attitude it would require this past week. That's a very important thing, that a true fact that most traders ignore because it's not convenient. Most traders ignore the reality and truth because they don't like to accept the facts and the truth that you can't tell when a day starts how it's going to end. What's tomorrow going to do on Monday? How about Tuesday? How about Thursday? What are they going to do? You have no idea. Neither do I. Matter of fact, we have no idea when the market's open. They could gap like back here at the end of March, first part of April. They could gap and go. They could gap one way and fill and then go the others. They could do anything. They could be 20 to 40 point S&P ranges, or they could be 7. We don't know. And the only way to capture the bulk of the gains every single day is to trade all day, every day, and accept the results. Now, of course, the next human thought is, well, if my system's good enough, if your system's good enough, then you won't take those losses. If your system is good enough, all you'll do is win. That's not true. If your system is good enough, what you'll do is win over time. So in other words, if you trade all day, every day, you'll make a lot of money on the days when it moves 20, 30, 40 index points. But on the days when it moves 7, 8, or 10 points, you won't make a lot of money. As a matter of fact, you'll probably lose money. That is a reality of trading. So your choices are, and only you can make the choice from your selections. Your choices are, you can choose to trade all day, every day, and accept the results, mixed as they will be. So you'll have some very large days, excellent gains. You'll have some days where you just miss large trades, and you'll be frustrated, and you'll press, and this and that, and it'll turn out however it turns out. And then you'll have some low range price action where you'll just lose money because you're going to churn and churn and chop and churn. And those will be your results. And how it all averages out at the end, no one can really say. Here is mighty crude oil, the darling of momentum traders everywhere, because most momentum traders are behind the curve and they remember what crude oil was, or it's gained its reputation for what it used to be instead of what it is now. Let's go back to the middle of March, and what do we see? Sideways, 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 day after day after day of sideways price action. And you try to catch something inside of these sudden jerks and spasms before price comes back the other direction. Drops and pops and drops, and maybe you caught something out of that if you tried to trade it all day every day, and maybe you didn't. Maybe you caught part of this drop, maybe you caught part of that pop, but I assure you, you were getting caught in the chop in between. Whatever your stop loss is, whatever your method of entry is, you were getting signals and you were getting stopped out, because that's what happens in chop. Nobody, with zero exceptions, has a system or a method that avoids all chop. If you do, you avoid a lot of, if not most of the solid moves too. It's impossible to avoid loss in trading. And the more sideways markets are, the worse losses become. That's a universal law that's applicable to everyone. And so market action has a lot more to do with your success than anything else. Let me rephrase that. High volatility and large range periods have a lot more to do with your success or my success or anyone else's than the method or systems that we use. Favorable market action creates favorable market results. That's why everyone wants to talk about their trading results back in 2007, 2008, 2009. Whenever you see somebody promoting what they did, they're always going to go back to, well, in 2008, I outperformed the S&P by fill in the blank. Well, of course you did, because the VIX was at 60 and the intraday ranges were anywhere from 30 to 100 points in the S&P. Of course you outperformed. How'd you do 2 weeks ago when the S&P's range was 7, 8 points, and that's it, all week? Big difference. Just like the old adage, don't confuse brains with a bull market. There's a whole lot of people that have made a ton of money these past couple of years just buying and sitting, or buying and buying. Quite frankly, especially momentum stocks, how they do in the past week or two in NASDAQ. As a lot of those former high flyers have nosedived, and this may only be the start. I don't think we're going to see straight selling straight through, but I think we're going to see a lot more volatility and a lot more downside action in 2014 based on what I've seen recently. Brains in a bull market. They're about to find out the same reality that a bunch of other trader investors did in 2007 and 8 and 2001 and 2. History repeats itself. What does this have to do with us? Well, we have choices as day traders, if indeed that's what we are. And I'm specifically talking about intraday trading right now. You can manage yourself and your trades in two fashions. You can go into a day with a predetermined plan that you're just going to trade every signal as they come along all day. And whatever the outcome is, it is. And I'll tell you for sure what the outcome will be over time. You will never finish at your equity high for the day every day. It will never happen. You trade all day every day, your equity high peak for any given session. Sometimes it'll be in the morning, sometimes it'll be midday, and sometimes it'll be at the end. And there will be losses in between. And there's no changing that. So the blind hope euphoria of many traders as well. If I just trade all day every day, I'll finish up most at my peak profits at the end of the day. I'll catch the main runner at the end of the day. It doesn't happen that way. That's not statistical distribution, because sometimes you're going to trade the morning that is great, and then the afternoon just chops and chops, and you're going to give back some of your morning gains that was your peak equity. That's reality. You don't have to believe me. The market will teach you that in time. I'm just, when I sit here and I talk about things, whether it's in public fashion like this, whether it's in a public workshop, whether it's in private to the team, basically I'm sharing real-time experience that I've learned in 12 plus years. And that's what somebody purchases when they purchase the educational package from me, when they pay money for in exchange for the information. What they're really buying is a decade of experience of learning the ropes, going through the learning curve, making all the mistakes, losing money on those mistakes. I've never made a mistake in trading that has made me money. Every mistake I've ever made in trading has cost me money. Lots of money. All right? That's the difference between figuring stuff out on your own, which I mostly did, and it took me, many years, or getting started in advanced at an advanced state, and then building from there, and then taking that information and making it your own. Back to the markets. Here's that same period of time in the Russell that we looked at in the S&P from the end of March onwards. Let's look at these ranges. From 1187 down to 1165. There's a 22-point range on the day the S&P went nowhere. $2,200. Here's that same large range day. 1182, 1150. That's about a $3,500 per contract range. 1165 down to 1145. There's a $2,000 per contract range. That's a 40-point S&P equivalent. 1150 to 1170, $2,200. 1170 to 1185, $1,500. 1182 to 1190, $800. That was really the only dead flat one, and that's 4.2. And then 4.4 was next, and on and on. All right. I've been frustrated by pretty much every symbol in the past couple of years at some point or another. Crude oil has frustrated me because it no longer is what it was. It was a symbol that would move 150-cent range was a poor day. 200 you would expect, 250 to 300-cent intraday range was the norm, was common. Nowadays, if you see a 200 or 300-cent intraday range, it's shocking, quite frankly. So, there's that. And it isn't that crude oil is untradeable, not by any means. It just isn't what it used to be. The S&P has disappointed me. It's traded fantastic this past week. If you're trading the S&P, the past week or so, you're killing it. You should be. It's making huge moves. How about the week before that we looked at? 4 sessions and never cracked 10 points, to speak of. How about then? Nobody tells you when the market's going to move and when it isn't. But look at the Russell. Even during the flat stretches, it made substantial moves. Now, that's the good news is the opportunity is there. Now the downside is the opportunity can be difficult to catch. It can be spiky, it can blow away, it can be tough to get filled on, it can be really whippy at times, it can be a lot of things. Temperamental comes to mind. But at least the opportunity is there on a consistent basis. And so for that reason, and I said to myself shortly ago, like, they can all be frustrating. Which pitfalls and shortcomings do I want to live with? Do I want to live with a symbol that's easy to get filled in and goes nowhere a lot of times for an entire week? Or do I want to live with a symbol that can be difficult to get filled in but makes, extreme moves in several of them, giving me chances to be correct? Back in that week where the S&P went nowhere, I don't care how good a trader you are. If you took 2 losses and it was halfway through the day, then there was only 4 points of range left. You can't make it back. You have no way to even get back to break even because the market was just pancake flat. But in the Russell, you can take some losses, however that might be, and you can work your way back to break even for the day or better. At least the opportunity is there. And so for that reason, I decided to, revert to trading the Russell, which I've had a ton of experience in, good and bad. There are times where it's just whippy and choppy and you can't get anything done. But I've had good and bad experiences with any symbol, crude oil, the S&P, everything else. And so what I'm doing forward, what I've done here the past week or so, chronicled in YouTube, chronicled in the same blog here, just like in the past, no difference, is I've focused on the Russell and I'm, have enjoyed the results of such. And that's what I'm going to do going forward on an intraday basis. How that impacts the educational program? Well, for just the core educational material in the team site, which is constantly being added to and growing, we cover everything. We cover the sweet trading in the S&P here of late, and the NQ with its 100 plus intraday ranges, 100 plus point intraday ranges. They've traded great, and sometimes crude oil trades great. And our methodology covers those. And like I said before, when the markets are moving great, you can experience great results. And when the markets aren't moving at all, you can't have results with anything of anybody's, no matter what. It requires market movement and volatility to make money on a consistent basis, day after week, not one day at random. The market was dead, but you caught the high or low tick and then you exited right where you should have, and that day turned out fine. I'm talking about consistency. On an intraday basis for the team room, I'm going to be trading the Russell only. That's the only focus in the team room with focus, with the trades called ahead of time, with all of the action zones marked. So in other words, I will say the action zone will be marked. I'll say, just like I did in the transcripts, if the TF breaks this level, that's a buy zone. If it breaks that level, it's a sell zone. I'm looking to get long or short there. And the actual fills will vary because that's how trading is. There's no way somebody can say, well, 1108.2 is the short, and anything other than that is, we don't even count, but 1108.2 is what we're going to count, and then the X is going to be whatever. I mean, that's not reality. That's not how trading is in the real world, and that's just fantasy stuff. But in the real world, you would say something like, all right, 1119.2 is the buy zone, so anything above 1119.2 within several ticks is the long, and something below 1116 is the short. So and of course those zones are marked on the live chart in live room, and when price action gets there, whether it's 2 minutes or 2 hours later, that's the valid trade. The trade's taken, it's managed accordingly, end of story. That's what we're going to do on the educational side. And what we demonstrate there is applicable to any symbol. The same tactics, the same approach, which is basically we're reading direction, we're measuring direction, we're identifying key support and resistance, and we're trading around those. That simplistic process can be applied to any symbol. I'm just demonstrating it using the Russell 2000 because my days of trading more than one symbol at a time on an intraday basis are over with. Now, on a swing trade basis, I'm working with Forex on a little bit slower pace, I'm using hourly charts to pick direction, and then I'm using 1,000 volume charts to trigger with. And I'm looking for 50, 80, 100 pips, 150, 200 pips on a trade. I'm not looking for frenetic stuff. So, sometimes there's no trades in a symbol in a given day, and then sometimes 3, 4 symbols, signal. And in that regard, I can watch a number of different markets. But there's no way for me to look at a 500 volume chart and a 200-ish tick chart in the Russell and really focus on that and catch the precision moves, and then look at the S&P and it's going a different direction, and look at crude oil and it's doing something different, and so on. I just don't have that in me, nor do I have the desire. There's no need for it. So that's the forward progress of the educational program. The core approach, we teach the same thing in how to trade anything with lots of examples. The live room portion of the educational program, it's not something that stands apart by itself or alone. It's in harmony. All we're doing is demonstrating in real time the methodology and approach. And the instrument I'm using to demonstrate that generic methodology is going to be with the Russell. And the results obviously going forward will be, as expected, what we've experienced backwards. And that is the extent of my intraday activity. And the way I'm going to manage my trading overall in my account is I'm looking for the, like I said, the daily take 5. If I hit -5 points in a drawdown, then I'm going to stop trading for the day. Something's wrong. Either something's wrong with the session or in price action, or something's wrong with me, or both. That's a day that I don't need to trade any further. And on the days when I achieve +5 points or better, then it's my personal election to either keep going forward or stop. And my objective is not to trade all day every day, and my objective is not to teach trading all day every day. My objective is to teach the process and the approach to be profitable more days than not. And if somebody wants to take those tools and take the same approach and they want to apply it further in any given day, they want to trade the whole day all the time, that's great. I don't discourage anyone from doing that. I'm simply teaching how to reach an acceptable, profitable point in a given day and then calling it a day. And if somebody wants to extrapolate that and try to make more profits out of it in many days, wonderful. By all means, you have my support, and I'm happy to do that. But me, on the other hand, that's not how I'm going to manage my trading. Listen, there's 21 sessions on average in a given month. If you could make 5 points a day on average for 21 sessions, you'd make 105 points per month, or $10,500 per each single TF contract. Well, nobody's going to do that, starting with me. I'm not going to average 100 points a month at all. But I would be happy with a third of that. 30 or 40 points a month, $3,000 or $4,000 a TF contract. That's fantastic. Absolutely nothing wrong with that. As a matter of fact, we did about that last week, and I think the past 6 sessions averaged out to be right around 30 points a contract. Hell, that's a great month. I'll take that. What are you kidding me? $3,000 a contract? If it took me 21 sessions to make that happen, perfect. Do that for the rest of my career. Any more than that is gravy. That's my mentality as far as trading. But other people might be, I want everything I can get. I want the experience of trading all day every day. I want to learn. I want, fill in the blanks. Then fine. By all means, have at it. I've done it. And you will experience all of the things that I have and that everyone else does, and then at some point you will make determinations as to whether that's what you want to continue doing, or whether you want to just trade for the first hour or 2 or 3, be profitable enough, and then cease and go out and do the things in life that you got into trading with to begin with. I'll leave you with this thought. There ain't a single person I've ever talked to who their reason for getting started trading was to be a trading addict. Not a single person was ever attracted to this industry for the sake of trading itself. And then somewhere along the way, a number of traders get caught up in the game. They get caught up in the contest, the competition, the challenge, the gambling aspect, if you will, and all of a sudden, greed takes over. Like, there's so much money flying around. This is all I want to do. I have a passion for trading. Well, that's okay. I've been through that stage. It lasted for years. I'm no longer at that stage. The stage I'm at now is this, and I'll ask you a rhetorical question. If you won the biggest Powerball or Mega Millions jackpot in history, let's say that and it's going to happen, that the next jackpot's going to be several $100 million, and let's say that you won, you're the sole winner, and that after taxes you have hundreds of millions of dollars, and you take it in one lump sum. What would you do the next day? Would you sit down at the charts with your passion for trading and try to bang out ticks in the S&P or crude oil or Russell or XYZ? Is that what you would do? You know, there you are, you're on the news and you accept your check and everybody congratulates you and you change your phone number and, the whole world is coming out of the woodwork to, rub elbows with you. What are you going to do the next day? Are you going to sit down and bang ticks in day trading? It's, oh, all right, I caught 7 points in the S&P. Is that what you're really going to do? Or would you go on to do all of the things that you have hoped and dreamed to do if money were no object in life? Let's keep it real here. We're trading for the money. We're not trading for the game or the accomplishment or the achievement or the bragging rights in a message board or on StockTwits or something like that. Nobody cares. We're trading for money and we're trading for success so that it will allow us to free up time. That's what we're trading for, the freedom of time. We're not trading to figure this thing out in 10 years. At least I hope you're not. It's taken me a decade plus to really figure it out. I figured out different stages through the course of time, and I thought I had it all figured out when in actuality I didn't. To be honest with you, here I am 13 years into trading. It probably took me 10, maybe 11 years to figure out everything enough. I just didn't know it at the time. Looking back, when I thought I knew it all, now I realize I did not. Imagine that. That's trading. We're here for the money. We're here to make money as fast as we can, as easily as we can, as painlessly as we can. And by no means is this easy. It's a very difficult profession. It's very challenging. It's very frustrating. It's very stressful. It's a lot of things. But it can be fruitful and lucrative and rewarding and worth it and empowering and freedom and all of those things as well, done right. And so that's pretty much where I'm at in the evolution of a trader, where I am today. I'm also going to make some subtle and some rather substantial changes to the educational program too. Not the information, but the way it's delivered. I'm seriously considering scaling back in the blog here, going to just one weekend post and probably doing a opt-in newsletter. I think that's the direction that I'm going to go for a number of reasons. So what you're going to see here in the not too distant future is an offer to opt in for a newsletter emailed several times a week, and then you're probably just going to see a one blog post a weekend in here, and that just to keep current, and that's about it. So other than that, here we go, and I'll leave it with this. We have demonstrated profitable trading, successful trading a number of times. There's umpteen YouTube videos, and the last one I'm going to do for quite some time, if ever, is already there. There are, copy-paste transcripts of the live room where trades and markets and price action are called ahead of time, where future levels are called, and in the future they go on to be fulfilled and all that stuff. There's enough there to choke a horse. I probably deleted a couple hundred prior entries that nobody was reading anyway, where we've been doing this for years. So that the markets can be traded, price action can be measured and predicted. Anyone can learn to do it. You can too. We can show you how. Be happy to work with you when you come aboard. Hope this helps. Hope you have an excellent weekend. Enjoy your summertime weather. And as always, best trading wishes.